Welcome to the Worth Knowing live stream. I'm Matt Robeson. What are the biggest risks, the biggest questions about the economy right now? Because the economy is sending two completely different signals. And the question is, which is actually a signal and which one is noise? This is not an abstract question. So much hangs in the balance of what's actually going on with the economy and how we feel about it, because it's the core of our lives. It's our jobs, our homes, the well-being of our families, whether we feel like we're getting ahead or falling behind, but also politically, it's still all about the economy, stupid. The perception that Donald Trump would do better than Kamala Harris on the cost of living was the number one factor for swing voters in deciding the 2024 election. And of course, for the voters who ultimately chose Trump, Pew Research showed that that was the very top issue. So it's not going too far to say that how we feel about the economy over the next 6 months is going to drive the midterm elections and therefore the next presidential election, and therefore the larger political question of whether MAGA Trumpism is going to be a short-term affliction or a long-term direction, a case of food poisoning or a chronic condition. Understanding what's actually happening right now and how much risk we're facing has rarely been more confusing or more consequential. Here's just one example. The basic question is the economy actually growing? For most people. And for economists, this is like being an EMT arriving on the scene and checking your pulse. It's the first approximation, vital sign of everything else that's going on. Well, again, there are two different signals here. Yes, the economy is growing. Our current best estimate is that the economy, the amount of stuff we make or the amount of money we spend, both kind of the same thing, expanded by 2.1% in 2025. Not great, but not bad. But our gross domestic product, the way we measure the output of the economy, was just revised downward in the fourth quarter to an anemic growth rate of 0.7%. That is, as the kids say, chopped. It suggests serious weakness in exports, consumer spending, government spending, and investment. Or look at the economy through the lens of jobs. Unemployment looks pretty good. It's only 4.4%. It's a level that economists think is generally pretty healthy. But we actually lost 92,000 jobs in February. Overall, in 2025, the economy only added an average of 15,000 jobs a month. That's like a statistical zero, a year without job growth. And we see the same disconnect if you look at the stock market, where more than half the growth has come from just 7 companies, the big tech giants: Apple, Amazon, Alphabet, Meta, Microsoft, Tesla, and NVIDIA. The overall rise in the market in recent years, notwithstanding the recent dip tied to the war with Iran, should have made all of us who have any retirement savings or investments feel richer and better off, but we don't. The Michigan Consumer Sentiment Index, the most reliable source of understanding how Americans feel about the economy, remains near historic lows, all-time lows. So what's the signal? The soar or the dip? If the economy is doing so well, why doesn't it feel that way for so many? Is this another vibe session, or is this that EMT not feeling a pulse? Or let's look at another key economic measure, inflation. It hasn't spiked, but it hasn't also gone away. It's been running about 2.5% to 3%, which is above the Fed's 2% target. So if you told economists this a year ago, they might have been impressed how resilient the economy has been because of all the price pressures and uncertainty created by Donald Trump's tariffs. But resiliency is a double-edged sword because inflation has remained so stubbornly and persistently elevated. So good news story or bad news story? This is beginning to seem like a patient who's been running a fever of 101 degrees for months and months. It's not high fever. It's not life-threatening, but doctors can't figure out how to get it back to 98.6 either. And now we've introduced a brand new factor, a Tasmanian devil of risk and volatility in the form of this war with Iran. Oil prices have risen above $100 a barrel, and gas prices are above $3.50 a gallon. But we don't know if this is going to be a temporary thing or the start of a broader economic shock where the waves will continue to be felt for years to come. The oil shock of 1979 created the shotgun wedding of stagnation and inflation, and their unholy love child, stagflation, which led directly to the consumer electronics revolution in Japan and the Reagan Revolution in the United States. So what's going to happen here? Short-term spike or the start of a fundamental shift? And politically, Republican strategists are already suggesting that Democrats are virtually certain to win back the House. I agree. Some of them are now openly discussing the possibility that Democrats could win the Senate if current economic trends continue. So Unclear. How far will all of this go? And one broader point about a deeper structural question. With a huge and growing share of our economy being driven by AI and the tech sector, are we going to see a broad increase in productivity and prosperity that's come with previous advances in technology? Or, as we think may be starting to happen, is all of this going to further concentrate wealth and fundamentally disrupt large segments of the American workforce? If you thought the trends in globalization, trade, migration, and manufacturing that led to the rise of populism, the disruption of Western democracies, and the rise of Donald Trump were disruptive, what's going to happen when we throw the gasoline of AI on that bonfire? So we're not just trying to understand what's happening now. We're also trying to understand how much risk we're facing as we move ahead. Some really fundamental questions here. Is the economy actually slowing? Will we finally get a handle on inflation? Are we at risk of a recession, or what feels to the majority of us like a recession? And how are we going to be thinking about all of this when we walk into voting booths in 6 months? What will come out the other side? There is no one better to help us make sense of all of this than one of the most trusted economic forecasters in America, chief economist at Moody's Analytics, Mark Zandi, who is spooling his way onto the show right now. Mark, I see you in the studio, but I can't see you up on the screen. I hope you can hear us.
I can hear you. You look great, Matt. Good to see you.
It's great to hear you. Physically seeing you, and
really?
you're all faded to black, and I can see you in the studio. So
you're coming through bright and shiny. You look good to me.
Oh, geez. I assure people that this is not Mark is not like redacted. There he is. You're not like redacted by the DOJ. There you are. Okay. Very good. It is really terrific to see you again. I'm really glad to have you back. And
Thanks,
I want to start out with kind of that big question that I teased a moment ago. As you look at the big indicators, jobs, GDP, is the economy weak or strong? What direction are we heading?
Can it be something in between that? It definitely isn't strong. It's not in recession, but it doesn't. It's not going anywhere fast, and it doesn't feel very good for most Americans. I mean, I was listening to your monologue before I came on, and I think you kind of nailed it. If you look at GDP, gross domestic product, the value of all the things that we produce, that's growing. Not gangbusters, but it's growing, and it's somewhat disappointing in that it's growing below what economists call the economy's potential rate of growth. So it's not growing fast enough to absorb even the weakened labor force, and unemployment's moving higher. So it's growing, but it's kind of a fragile growth. And the thing that's really uncomfortable and bordering on disconcerting is that we're not creating any jobs. Job growth has flatlined since this time last year. Literally, I mean, you can look at the February employment figures. They're no higher. In fact, they're a little bit lower than they were back last April when President Trump had Liberation Day and raised tariffs. And the only sector of the economy that's adding jobs is healthcare. It's a big sector. It employs lots of folks, and you have hospitals in every community across the country. So I'll take it, but that's it. Every other industry is either adding a bit to jobs or losing jobs. The net of it's not going anywhere. So when an economy isn't creating any jobs and unemployment's inching higher, I guess the way I would think about it is we're growing, it's okay, but it's a very fragile and tenuous growth. Nothing else can go off script. And of course, as we can see, many things can go and are going off script with what's going on in the Middle East.
As we move later in the show, I want to ask you kind of one of my favorite economics questions, which is, what's the one economic indicator that you watch most closely to read the tea leaves about where things are going? But I want to leave that in the parking lot for now.
Okay.
And I want to ask the more kind of immediate version of that, which is, what is going to make you decide right now that things are starting to turn south and you're seeing more weakness than strength?
Well, I think the kind of the firewall between this uncomfortable, fragile economy that we have and something darker, a recession where we're losing jobs and unemployment's moving higher, are layoffs. So far the weakness in the labor market, the job market, the fact that we're not creating any jobs goes back to no hiring. Businesses just simply aren't adding to payrolls. It's not like they're cutting payrolls. I mean, some companies are. You read about Block laying off 40% of its workforce. Rumors that Meta is going to have big cuts. You can see other tech companies have been paring back, certain other industries. But in the broad scheme of things, we're not seeing we're not seeing any meaningful pickup in layoffs. And that's what I'm watching. If, in fact, for whatever reason, say consumers pull back because they have to pay more for gasoline and home heating and anything related to the run-up in oil prices, and start laying off workers, then that firewall will come down and we'll go into recession. And again, we're in a pretty tenuous spot, very fragile spot. But I think that's the key to what we've got, and something worse than that.
There's a debate spooling out right now about whether we're seeing the early warning signs of an AI-induced suppression of hiring. You mentioned that employers really aren't adding to payrolls. Maybe there is some uncertainty in that. I know that, companies that I have worked for, the internal scuttlebutt is, gosh, we have AI tools. We could probably get AI to do this, or they're experimenting all the time. So when you read those tea leaves, do you think that's a factor? Do you think that that's part of what's going on that's kind of restraining hiring, or do you see it as more of a technology enabler of more productivity and more growth?
Well, I think so far, that the fact that we're not creating any jobs, I think AI, in the anticipation of what AI might mean for businesses, is probably on the list of reasons why businesses aren't hiring, but it's not at the top of the list. Certainly not yet. I think if you go back and look where job growth kind of went sideways, it was with Liberation Day back last April. So I think it goes directly to the higher tariffs. We're losing jobs in manufacturing, which is direct hit from the higher tariffs and the pullback in trade. We're losing jobs in anything agriculture related, because the farm ag sector sells what it produces, a lot of it to the rest of the world, most notably China, and that's all been hammered. Transportation distribution, that's an industry obviously moves stuff around, and that's gotten hit hard. So that's the direct hit to jobs. Then you've got DOGE cuts to government, so that's a couple 300,000 jobs that have been reduced because of those cuts. And then I think broader, what I'd call uncertainty, anything related to policy, tariffs, immigration policy, heavy-handed immigration policy, what's going on overseas. It feels like, every month we're, fighting another battle somewhere, and a lot of drama. Businesses are having a hard time getting their mind around. And then, AI may be playing a role there. There's some academic research kind of connecting the dots between AI and the employment experience of younger people, particularly college educated in as you can imagine, the computer sciences or programming or customer support industries that would be most disrupted by AI. That doesn't mean AI isn't going to play a much bigger role. And then that's another reason for a bit of angst here in 2026, is that, well, in fact, AI does kick into a much higher gear. Businesses do start to adopt, and they actually get to a point where they start laying off workers. And that's why, for example, I mentioned Block. Block is the fintech company that laid off, 4,000 people, or is in the process of laying 4,000 people out of 10,000. And that's an industry you would expect to be disrupted by AI. And they're saying we are being disrupted. So that, there may be other things going on there. There might be other reasons why they're laying off workers, but that's a tell that, AI is coming on. So AI has played a role, but it's been a bit player. I think it's going to play a much bigger role going forward. And again, in a world where we're not creating any jobs, with AI not being doing much of anything there, what does that mean going forward if AI really does kick into gear?
Just one more on the macro economy. There's a lot of chatter in kind of the chat community here about this disconnect between high prices, corporate profits, the fact that we may be in an AI bubble. We talked about the Mag 7 really fueling the rise in the stock market, the S&P 500. Is this a market bubble that's an opportunity for the crooks? As Lefty Gramps says, what about this disconnect between what one might call a fundamentals view of what should fuel stock growth? It doesn't seem like this is based on the fundamentals per se. It doesn't seem like it's based on the fact that there's been a lot of cheap money being pushed out by the Fed that has to go somewhere. So it's going into the stock market, because that hasn't been the case in the last few years. Is this just like zombie mutual funds are just plugging ahead? Is the market just not reacting to real-time economic data? Why is there this disconnect? And is it a bubble that's going to pop?
Well, the way I kind of would frame what you just said is that valuations in the stock market are very high. So if I look at, the stock prices, and I compare that to the earnings of what businesses are generating, that so-called price earnings multiple, PE multiple, which is a measure of valuation, it's been higher in the past, but rarely. The last time was during the Y2K bubble, and that was a bubble when we saw the stock market suffer a big correction, and a recession followed. So, we're in that territory. So I think it's a reasonable question to ask. And, I don't know. I'm uncomfortable with the valuations. I'm uncomfortable with the fact that a lot of capital has come pouring in, both equity and debt, into the sector, and is resulting in a lot of investment spending, but a lot of kind of circular kind of investing in each other. So there's not a lot of transparency and all that. So that makes me uncomfortable. So I would say that there is a not inconsequential risk that we see the equity market correct, where we see prices come in and investors finally bring down prices more consistent with earnings. Now, having said that, it could very well be the case that investors are right, and this goes back to what we were just talking about. I mean, if investors are right that AI is going to come on big time, and it is going to allow businesses to generate huge productivity gains, which is to their benefit, is going to result in more profits to those companies, including the AI companies themselves, well, then these valuations could be justified. So, it could be very well be the case that the stock market is fine, but the labor market isn't, that we see all these job losses, occur because of the productivity gains that result from all the investment that's going on. So it's kind of a, kind of a very tricky place. It goes back to the word I've been using, fragile. Kind of the economists would say, in the most likely scenario, is this all going to work out reasonably well? Yes, valuations are high, but tech companies are going to be able to do just enough to support those valuations, and we're not going to see so much productivity growth so fast that we're not going to lose a lot of jobs, and the economy is going to make its way through reasonably well. But there's boulders on either side of that path. The one we talked about both of them. One is, well, investors are right, and there's going to be tremendous productivity gains. Well, that of course means we're going to see more job losses than we would feel good about. It may be a problem, may not allow the economy to move forward in a graceful way. And the other is the one you were alluding to. The boulder on the other side is, well, maybe investors have this dead wrong, and we're not going to see those productivity gains. And if we don't, these valuations are too high, and we are going to see a significant correction in stock prices, and the result will be recession. So that's a long way of saying a boatload of uncertainty around all of this. The most likely is we kind of navigate through, make our way through reasonably well, but I don't say that with a lot of confidence. And just to end the thought, this goes right back to where we started. Why aren't businesses hiring? Well, what I just said is a pretty good reason why you'd want to be cautious, because of the uncertainty around this, and it's just impossible to know, exactly how this is going to play out.
Well, it gives me great comfort that one of the people on earth who knows the most about this topic is reflecting a certain amount of uncertainty and confusion about where all of this is heading. That shows a remarkable amount of capacity for humility on your part, which is very admirable. But it does make me feel better. It's like you're telling me it's like it's okay, like it's the way I set it up at the top, to find ourselves at kind of an inflection point and to be confused about which direction this is going. And part of what you were saying in there is it is quite possible, as Lefty Gramps suggested, that productivity could equal screwed workers. It is also possible that we could see, like earlier iterations of technology, getting Microsoft Excel didn't mean we got rid of accountants. It meant that we started being better at some of the things we did. Right now, there's certainly enough warning signs to be nervous about the former version of it. I want to turn over to kind of the second question. We've given a mixed answer, I guess, on the first one, which is the economy getting weaker? And it seems like the answer here is it's fragile. It's weak. It's teetering. It really could go down. I want to talk about prices. I want to talk about inflation. The way economists talk about this is inflation. The way regular humans experience it as prices. And I never want to lose sight of that. To me, the answer to the political conundrum of why people were so unhappy a couple of years ago that led to the election of Donald Trump with the economy was that disconnect. Even as we began to get a handle on inflation, prices were still high. Life was still unaffordable for so many people. And so I want to recognize that up front. But we still do have this problem with inflation. We still kind of have this lingering fever that we can't quite get rid of, which suggests that there's an underlying infection. Why is inflation so hard to get control of?
Well, it was, if you go back a year ago, it felt like inflation was coming right back down to something that we'd all feel comfortable with. I mean, just to give you a number, the Federal Reserve Board targets 2% inflation. They look at the consumer expenditure deflator measure of inflation. They say if it's 2%, that's exactly where I want it. Anything higher than that, I'm uncomfortable with. Anything that's meaningful below that, I'm uncomfortable with. I want 2%. If you go back a year ago, before the tariffs and the immigration and everything else, inflation was decelerating. It was coming in, looked like we were going to soft land. Inflation was going right down to 2%. Of course, things changed. The tariffs, the heavy-handed immigration policy, those policies are inflationary. The tariffs, by definition, are inflationary. You know, it's a tax on American businesses and consumers, you and I, and that tax is in the form of the higher prices we have to pay for imported goods. So that caused inflation to pick up. And by the way, that goes to the uncertainty, the lack of job creation, the loss of jobs in manufacturing, everything we just talked about, and one of the reasons why the economy is fragile. The other is the heavy-handed immigration policy and the fact that immigration has, I have no problem with controlling the southern border. I think that's a good thing, but we've gone well beyond that, and we're seeing immigration flows into the country that are half what is typical. Going back many decades, we'd get about 1 million immigrants every year, both legal and undocumented. Now we're down to, there's some debate as to exactly how low, but 250K, maybe 500K. So that makes life very difficult for businesses that rely on those workers. So agriculture, construction, retail, leisure, hospitality, transportation, distribution, to a lesser degree, manufacturing, all childcare, elder care, personal services, all rely very heavily on that. And the companies can't find those workers, and that causes prices to rise. It makes it difficult for those companies to produce. It weighs on growth, but it also causes wages to rise, prices to rise, and costs to rise. So it's a combination of those policies, conflating, that puts inflation out higher. And now, unfortunately, we're getting nailed with the war in Iran and the impact that's having on energy prices and agricultural prices through fertilizer and everything else. And that's just going to add to the inflationary pressure. So I said 2's the goal. We were headed back to 2. It felt like we were going to soft land. We're now at 3. The most recent data puts us at 3%. And, that's before the effects of the Iran war. That's going to push it up even higher. So if you told me, by June, July this year, we're at 3.5, close, maybe even 3.5 to 4. I don't know that I'd be surprised with that. And that's going to feel, we're going to go from being uncomfortable to very uncomfortable. And another reason to worry about that fragility in the economy and the potential for the economy, businesses pulling back, laying off, and us going into recession.
I want to go ahead and hit you with Lefty Gramps' question here. When the supply chain is fixed and corporate profits are all-time high, the prices never go down. And I guess let me just pile on to that question a little bit. I mean, it sounds like I agree with what Lefty is saying here, which is that from a regular consumer slash voter slash American slash human standpoint, what you really want is for prices to come down. We did see that because of some short-term effects with eggs, for example, but most prices, you're not seeing deflation here, and that's not going to be the source of greater affordability. Most of the time, from an economist standpoint, what you're hoping for is that you get the rate of inflation low and controlled enough so that rising real incomes overtake it, so that people find things to be more affordable, right? It's not like absolute prices go down, it's that your income overtakes them by enough that you're better off. But why don't prices ever go down, given corporate profitability?
Well, some prices go up and some come down. Commodities, you mentioned egg, agricultural prices,
Right.
Gasoline prices go up. Although, there's that old adage that prices go up like a rocket, come down like a feather. And that's what we see when there's any disruption. Businesses jack up prices, and the cost of a gallon of regular unleaded back 2 weeks ago was less than $3 a gallon. We're now closing in on $4. That's a pretty rapid increase in price. That's a rocket. And ultimately, those prices come back in as competitive pressures kick in, but that takes time for that to play out and for prices to come in. But those are commodities. For most other goods and particularly services, you're right. The prices are very sticky. They generally do not fall. Businesses are very loath to give up to cut price, because if they start cutting price and cutting margin, then they might have to go back to their workers and say, hey, I can't, not only am I not going to pay you an increase, we're going to have to work together to get your wage down. And it just gets very uncomfortable. And also the other thing is, a lot of these companies take on debt and borrow money to help finance their expansion. That's based on the prices that they have. If prices actually started to fall and their revenues started to decline, they have problems making payments on that debt. We'd see defaults, and that would create its own set of problems. So, this goes back to Keynes. Remember Keynes back, in the World War II period, the very famous economist. He said prices are sticky, and prices and wages are sticky, and that's why in our system. But you got it just right. I think the way we want to restore affordability, make people feel more comfortable that their earnings or income is sufficient to do the kinds of things they need to do to have a reasonably good life, is we want stronger wage growth. If prices kind of go flattish or growing slowly, and you have wage growth that's stronger, that's the way we get back to affordability. And, to some degree, we were there. Again, I go back to this time last year, inflation was headed to 2, wage growth was 4 to 5. You kind of do the arithmetic. You say, okay, people are going to start feeling better. And in fact, people were starting to feel better. But now we're at 3% inflation headed north, and wage growth is decelerating. It's a little over 3% and headed south. People feel that, and that's making them very uncomfortable. And people do forecasts, right? So when you see inflation slowing and wage growth accelerating, you go, oh, this feels, I can see where the world's going to look even better a year from now and 2 years from now. And that affects people's ways of thinking about things. But here we are on the flip of that. They're seeing inflation accelerate and wage growth decelerate, and say, oh my gosh, if that continues, what's the world going to look like? My life is going to be even more difficult a year from now. So that also plays a role in how people think about and perceive what's going on. But you got it just right. The most desirable way to restore affordability is strong wage growth, strong earnings growth, and hopefully inflation getting back to something that's closer to the Fed's target.
Right. And I want to acknowledge Lefty's summation of it, which is the corporations keep their ill-gotten gains, which is, I think, a slightly frostier way of saying, like, yeah, once you've managed to raise prices, you're not
going to give it up.
You're not going to give that up. And I think we all agree about that. Because the conversation online is going there, let's go to the third big question that I think is the big risk, the big driver here. Are we headed for another long-term oil shock? The calculation clearly out of the Trump White House is Yeah, we're going to have an oil price spike. We're clearly having one. They seem to have been taken a little surprise that the Strait of Hormuz is like a thing that they have to worry about. That seemed to kind of come out of left field for them.
Yeah.
Weird the way that happens. But I guess the question is, how vulnerable are we at this point? I mean, this could be a temporary spike, or it could be the start of a big shock to the system. Are we really vulnerable to that?
Well, I'm hopeful this comes to an end quickly. And when I say quickly, days, week, next week, hopefully this Friday, that the president can figure out a way to declare victory, kind of stand down, move on, and hopefully the Iranians play ball and don't push anything, and allow the strait to reopen. And it's going to take a bit of time to get things back to normal. When I say a bit of time, a couple, 3 months, just because everything's been so disrupted. So oil prices, if that's the scenario, and I'm still very hopeful that that would be the case, then I think this will, go down in history as a blip, not very uncomfortable, disconcerting to watch, but not economically damaging to a significant degree. But now, having said that, with each passing day, I feel less and less confident that that's going to happen on a lot of different levels. I mean, the president feels like he's getting a little bit more dug in here and is struggling to figure out a way to reasonably declare victory, and that's a problem. And then even more problematic is, even if the president does figure out a way to stand down, the Iranians, I don't know that they are going to play ball. They're going to continue to be disruptive and disrupt traffic through the strait. And if that's the case, then it's going to be very difficult to restore kind of normal production of oil, and oil prices are going to remain, uncomfortably permanently higher, at least for the foreseeable future. So that, I think the most likely scenario is this plays out reasonably gracefully, but we'll know pretty soon here in the next few days, next couple of weeks, whether that's the case or not.
And to be clear, this isn't necessarily just about gas prices. Here's another point from our friend Lefty: diesel closing in on $5 a gallon in Ohio. What will that do to food prices? And as you alluded to before, fertilizer, plastics, all kinds of petro-derived products and services that spin off of the products. This could have ripple effects. And so, again, to me, it kind of it feels like there's a tipping point where this goes on long enough and it becomes harder and harder to unwind what's spooling through the economy. We've certainly seen that in the energy sector before, where, a price effect persists for long enough and it starts to affect the production chain, the distribution chain. It starts to affect consumers in all kinds of ways. And it's not as easy as just, the flow is turned back on. The economic effects can really persist.
Absolutely. Yeah. And that's to my point about each passing day. I feel less comfortable with any kind of optimistic scenario here, because I like the word spooling. It will start to spool. I mean, groceries, first off, anything that is put on a truck, prices are going to go up, right? Because as you pointed out, diesel has gone up even more than gas, and much more quickly. And so if you, to get food from the farms or the ports to the store shelves, it's now going to be a lot more costly. Any package get delivered by Amazon, UPS, FedEx is going to be more costly, and that's going to airline tickets, because jet fuel costs are going up. So not only are you going to stand in your TSA line for an hour or two, but you're going to pay more for your ticket price pretty fast. Again, back to my point, prices go up like a rocket and come down like a feather. They're going to go up pretty quickly here. And then if it persists and it continues on, then prices for lots of stuff will start to rise. Anything manufactured, all manufactured goods use a lot of energy. Anything in the construction trades, anything in transportation, public transportation, the prices will start to rise. Clothing, pretty much everything. And then ultimately, if in fact the higher prices for energy really persist for an extended period, not for weeks or months, but for quarters, then it's going to start showing up in business workers are going to say, hey, my purchasing power is getting eroded, Mr. Employer or Miss Employer, you're going to have to pay me more. So wages start going up, and that gets into the inflation. And then you get into this kind of dynamic where wages and prices are driving each other, and that's certainly not a place you want to be. If you get into that kind of scenario, that's where the Federal Reserve says enough already. They're going to start jacking up interest rates. I don't think we're a long way from that, but that's kind of, if you take this thing to its logical conclusion, if prices remain elevated for an extended period, that's the kind of thing that we'll start talking about and will ultimately start to happen. So, yeah, the effects of this are already consequential on Americans, and it will become much more consequential with each passing day and each passing week that this goes on.
That leads pretty nicely into the fourth issue, the fourth big risk that we wanted to tackle today. And this is the kind of thing that I think has lost all meaning in political discourse. I don't think it's lost meaning from an economic standpoint, but the question of recession it's always been fraught. For one thing, there's a rule of thumb definition of a recession that is not the actual definition of recession, right? 2 straight quarters of negative GDP growth. But that's not the actual rule. There's like this arcane board of like monks who live in a basement at like this economic bureau that you've never heard of, who like slaughter a chicken and watch the blood spatter, and they're like, recession. No, wait, it's not a recession. And this, of course, became a political football back during the Biden era, because Republicans were like, we're in a recession. We really are. Even if this board hasn't said it, we are. We definitely are. And then, of course, you have actual consumers, actual humans who don't really give a shit about what this board says. They just feel like we're in a recession, or we're not. So I want to ask you about whether a recession's on the table, but I want to take a step back and just ask you, as a total expert, what's a meaningful version of this question? Like, what's a meaningful definition of a recession, and are we going to potentially trigger one of those?
Yeah, I'm going to paraphrase that the group of what'd you call them? Monks?
Yeah, weird monks. They're part of the Order of the Divine Severity, I think.
Yeah, the National Bureau of Economics. Actually, they're very nice people. I know them quite well.
I'm sure some of them are your best friends. I don't mean to. I have many economists that I deeply love and respect, but there you go.
They're these are academic economists sitting at Harvard and Princeton and Stanford and so University of Chicago, that kind of thing. And they, I'm paraphrasing, so I don't have the wording exactly right, but a recession, as they define it, is this group defines it, the Business Cycle Dating Committee of the National Bureau of Economic Research, is a broad-based, soak that in for a second, broad-based across lots of industries, regions of the country, persistent, not just for a month or two, but for a quarter, 2 or 3 or 4, decline, so an outright decline in economic activity, right? So that's a pretty simple kind of definition, obviously very complex to effectuate and to implement. These folks look at a plethora of economic data, a boatload of economic data. They rely more on some than others. They look at so-called coincident measures of economic activity, things that are lined up at the same point in time. And intuitively, the single most important variable they look at is employment, jobs. And I think most Americans can get their mind around that. If you're seeing jobs decline across lots of industries, affecting lots of demographic groups on a persistent basis, again, for more than a few months, 6, 9, 12 months, you got a recession on your hands. So if you take that kind of framework and put that and consider where we are today, as we've been saying, there's no job growth. It's not declining, but there is no job growth. And by the way, Matt, if the nationwide job growth is flat, that does mean big parts of the country are experiencing declines. I mean, I mentioned manufacturing, transportation, ag, they're losing jobs. You go into different parts of the country regionally, just take a look around Washington, D.C., for example, because of the Doge cuts, you got lost jobs. But at this point, it's not broad. The declines are not broad-based enough or persistent enough to say this is a recession. But again, we're pretty darn close. And I keep going back to the word fragile. It feels like we're in a very fragile place.
I
that's not satisfying.
No, you're prompting thought, which is what good conversations are supposed to do. I was an economics student as an undergrad. I graduated with a degree with distinction in economics. I love economics. I wonder if the profession is failing in a way, because the more we talk about this, the more I wonder if we just lack the language to have a meaningful conversation or to meaningfully measure people's lived experience with the economy and what we're able to measure and track and describe and talk about, especially as macro economists, right? I'm reminded of the metaphor that I overuse in my own household of the guy with his head in the icebox and his feet in the oven, and on average he feels fine. We've got a stock market that has grown 18% over the last year, but that's fueled 50% of that growth comes from 7 companies, right, who now have about a third of total market capitalization. If you're working in one of those sectors, and if you live in one of the places that happens to host a headquarters, or you're downstream in one of the sectors that thrives off of the growth of those companies, you work for an electric utility that's building a data center, you're doing well, you're doing fine, and you're probably earning an income that's helping you stay ahead in real terms. But again, like, your head's in the icebox, your feet are in the oven. And on average, we can look at the macroeconomy, and your friends at NBER, who I'm sure are wonderful, brilliant, probably like former classmates of mine who are doing something kind of interesting with their lives. I just, they're describing the GDP. They're describing aggregate jobs. But I wonder if they're losing the texture in those broad averages. And I wonder if we're kind of lacking the language to get to some of the comments that are coming in here. The retirees who are part of the audience, Cynthia Rice, talking about like, hey, I'm a retiree. I have some experience with economics. I work for Paul Volcker. This isn't working for me. The vast numbers of Americans who tell pollsters, the economy is not working for me. Life is unaffordable. I could give 2 shits what the inflation rate is. I can't afford to pay my bills. This is a total step back that really doesn't have to do with, I don't know, the whole question of whether we're going to enter a recession is just sort of, it leaves me wanting with, do we need new language, new analytical tools, new ways to talk to regular people to say, tell us what your experience with the economy is, and we'll figure out a better way to measure that and reflect that back to describe, is the economy struggling?
Yeah, I can see why you graduated with distinction. You should have gone and got your PhD, Matt. You make a great economist.
I wasn't smart enough, and I did very poorly in linear algebra.
I doubt that. I think you make a great point. I think we get lost in the kind of the averages and the means, the medians in the middle of the distribution. It kind of assumes that the distribution is this nice bell shape, with the tails of the distribution that are relatively small. That if I take the mean or the median, that does a really good job of describing the bulk of Americans in the country. And that doesn't feel like that's the case. That distribution isn't nicely bell-shaped. It's a lot flatter, and you have a bigger group on one side of the tail. They're doing really, really well. The people that own the stocks and the AI companies, and are working at large businesses and getting big bonuses. And then on the other side of the distribution, again, a big group of people that are really, really struggling, can't figure out how to even, save any money to potentially get the down payment necessary to buy a home. There's just no prospect for that, happening anytime soon. And so we're in an economy where the kind of the distribution of experiences is very different than has been in the times of the past. And we don't have a good way of measuring that, or certainly talking about that. And I think you make an excellent point. I will say, though, in terms of perceived, how people perceive their financial situation, I do think the other thing that's playing a role in kind of this vibe session is our politics and kind of our fractured way of thinking about things. We're all looking at the world now increasingly through our own political prism. And if the party in power is not our party, we've got a very different perspective on things. And you can easily see that in all the various surveys that are being done. Go back before President Trump won the election, Democrats were feeling pretty good about the economy. Republicans thought this is the worst economy, ever, really, even in the worse than the pandemic or the global financial crisis. Now go to the other side of the election, that completely flipped. So, our perceptions are also colored by lots of other things that are going on. But I totally agree with you. I think our language is just inadequate for describing kind of the situation that we're in right now. We're in a very different world because of the lived experiences of people.
I get into a lot of trouble because I like to dictate texts. And I got into a long exchange with another former congressional chief of staff who happens to be a Republican. I'm a Democrat. And, we were talking about something having to do with some other topic, and it rendered as, well, you can stipulate a termite. So I'm going to stipulate something here. I might even stipulate a termite. I'm going to stipulate that people feel really negative. We know that from the Michigan Index of Consumer Sentiment. We know from what you just said. We know that people feel like, whether you call it a vibe session or whether you call it just views on the economy, whatever the aggregate numbers and the medians and the meads and the modes that you just spoke to, whatever they say, people feel negative. So the question, especially for a politics-focused show like this, is, where are we going with all this? And I want to land on that question. I think we understand broadly the first part of this question that's up on the screen, why people feel so negative. They feel like they can't afford life. They feel like things are not going in a good direction in terms of their income prospects, their employment prospects, and their affordability prospects. But given everything that you're seeing in the economy, where do you think that sentiment is going? Where do you think we're going to be going into the election in terms of how people view the economy? Or is there just too much uncertainty to say?
Well, I think the economy is fragile. I don't think it's going anywhere fast. I think recession risks are high. I think I can say with confidence that people aren't going to feel any better 6 months from now. I just don't see that happening. And I think there is a reasonable probability that things go in the wrong direction. We see some layoffs. We see unemployment rise. Recession is a real possibility. And of course, if that were to happen, then they're going to feel a lot worse. So, I don't think there's any reasonable scenario at this point for 6 months from now, people are going to be feeling better about how things are going. In fact, the war in Iran and the fallout on energy prices, oil, natural gas, fertilizer, everything else, pretty much seals the deal, right? Because that's all going to flow through over the next 6 months. And that suggests that inflation's not going down from here. It's going to go be higher 6 months from now. And it suggests that growth isn't going to be better. It's going to be, worse, from here. So I just don't see how we land in a better place economically and how people perceive it, 6 months from now compared to where we are today.
Well, let me read that last point back to you. It sounds like what you're saying is it's quite possible that the disruption of the war with Iran might be a short-term blip, as the White House is dearly hoping that it will be. But that won't matter in a way, because even if we've moved on from the temporary oil price spike, we've sort of set an upper bound on how good people are going to feel. They were already feeling negative and on a downward trajectory. This is only pushing that further along.
Yeah, that's right. I don't think what's going on, that we're paying $4 for a gallon of regular unleaded has actually been cemented in people's minds yet. It's too early. They haven't been to the gas pump enough times to, feel that or recognize that or internalize that. But another couple weeks, going to the gas pump once, twice each week, they're seeing $4 and even potentially moving higher. And then starting to go to the grocery store and starting to see, oh my gosh, I'm paying more for pretty much everything I'm buying, from the tomatoes to the oatmeal I eat every morning. And I'm telling you now what I eat every morning. It's oatmeal. I eat oatmeal every morning.
I hope it's not oatmeal and tomatoes, man. I don't know. I can't get around
really?
that.
Oh, come on.
Oatmeal and tomatoes?
Oh, no, not for breakfast. You're right. I got it. Yeah. I hear you. No, blueberries.
No, it goes together like nuts and gum.
Yeah. Well, those monks,
right. That's what they eat when they're sequestered down in the basement of the NBER.
Someone's got to eat them. Yeah. So, if this all came to an end tomorrow, maybe it doesn't have much of an impact, doesn't resonate. But in another couple of weeks, I don't, I think it gets cemented in people's kind of collective psyche. And I don't know you could break free by the election day, even if it did start to come in before election day.
All right, let me hit you with a question that I teased at the top. I know every economist has their pet indicators, their pet data that they like to look at. Alan Greenspan famously had all kinds of abstruse measures that he liked to keep an eye on, like the price of, I think it was like the price of boxer briefs or something, because he figured that, people don't replace their underwear with holes in it if they're feeling particularly under the gun in terms of their income, which feels like a weird place to skimp, but whatever. I guess people don't see your underwear. In all seriousness, what do you to this larger question? Oh, Cynthia wants to weigh in on the oatmeal question. In all seriousness, to this question of where we're going, I recognize that there's so much uncertainty. We don't know how long the war with Iran will persist. We don't know what's going to happen with oil prices. We don't know what's going to happen with the macroeconomic data, which keeps getting revised in fairly significant, meaningful fashion. What's the number one thing you're keeping an eye on? What's your indicator that people watching and listening to this can use to help them get a beat on where things are going?
I'll give you three real quick. It kind of what matters most to folks in the bottom third of the income distribution is how much they're paying at the pump. So we're now paying $3.75. If that keeps going north to $4.25, that's a signal that they're going to have to pull back because they don't have any option. They're living paycheck to paycheck. If they have to put more of their hard-earned money in their gas tank, that means that they got to make some hard choices. For the folks in the middle part of the distribution, it's really all about their job. And so I'm looking at going back to where we started, layoffs. And the best measure of that is the number of claims for unemployment insurance. If you become unemployed, knock on the UI office door, proverbially. It's now virtual, obviously, and get a check to help navigate your way through. That remains very low, but if that starts to move higher, and I can give you precise numbers, but just generally starts to move higher, then that's a signal that businesses are laying off, job loss is going to occur, and that's going to nail folks in the middle part of the distribution. And for folks in the top part of the distribution, it's all about stock prices, right? Stock prices are kind of wavering, but they're not too far from their record highs. They might be down, last I looked, 3-4% from their record highs. So they're still, people are feeling okay. But if we see that correction in AI stocks, or for whatever reason, stock market starts to go south and you see a lot more red on the screen than green, in a consistent way, that those group folks are going to start to pull back, and spending will weaken, and we'll get those layoffs and go into recession. So those three indicators: gas prices, UI claims, and the S&P 500.
And to the extent that, these things interact with one another, right? This is what makes your job super interesting and super challenging, right? Because if we have persistent price shocks based on, let's say, oil prices, that can flow through to the Fed deciding to keep interest rates high, which can then affect stock prices. If part of the theory here is the amount of money that's available that's got to flow into some kind of investment, that could start to put a damper, or the bubble could just freaking pop eventually.
Yeah, no, absolutely. Generally, a leading economic, by the way, the indicators I gave you were all kind of leading economic indicators. I said jobs are coincident. UI claims are kind of they lead in part because of the data. It's weekly data, so you get more of a real-time read on what's going on. But that's kind of, stock prices are kind of a leading indicator, because stock prices have to go down or up, and then it affects people's behavior and spending, and then ultimately economy and the jobs. And gasoline prices, it's kind of leading. If they're going up or down in a meaningful way, it takes time for people to internalize it and then start to change their behavior in response to it. So those are three measures and they all are, as you point out, related. I mean, if we're going to get layoffs and recession, stock prices typically always go down before that. And if gasoline prices are rising, that means oil prices are rising, and that's putting pressure on the broader economy and stock prices and jobs. So they're all conflate, but it's kind of a nice, easy way to kind of get your mind around things if you just focus on those three. And they're all real time. Gas prices obviously are real time, stock prices are real time, and UI claims are every week. So those are kind of, you can look at them on a ongoing, continual basis and get a sense of what's going on.
And I'll just say from a political standpoint, because that's more of my focus.
Yeah.
I have been thoroughly convinced by the experience and the evidence of the last few years that what matters here from a political standpoint, affordability trumps jobs, prices trump growth. And so, I'm going to be looking, for example, at the Michigan Consumer Sentiment Index and the Inflation Expectations Index, to the extent that inflationary expectations are predictive of actual inflation. You see here the comments here in the chat about, maybe unemployment is less of a predictive measure.
It's a good one. He's actually, whoever puts the gig economy really is mucking up with the UI claims. He's good, really good point. Yeah, very good point.
Absolutely. And so, to me, if I've got to choose one thing, I'm going to choose prices. I'm going to choose absolute prices. Can people pay their bills? Do they feel good about whether they're getting ahead or not? To me, that's the barometer. Speaking of getting ahead, I want to take a moment here to preview something that's coming up tomorrow that is very exciting. This live stream is going out on my YouTube channel, my Substack, but also our old friend Cliff Schechter, one early participant here, bemoaned the fact that it was me today and not Cliff. Well, if you want more Cliff and more top-level amazing guests from all across the online ecosystem, have we got something amazing coming up tomorrow for you. It's the Blue Ant Media Substackapalooza. That's a mouthful. Here are just some of the people who are going to be part of this. Glenn Kirshner, Chris Matthews, Julie Roginski, John Tester, Jonathan Larson, me. I actually got the cleanup spot, the very last spot here with Cliff and all of the people who contribute across the Blue Amp Media Network. This is going to be a 12-hour live stream, and we hope that people will be on for as much of it as they possibly can. Stop in, say hello, lob questions at us, have a good time, hang out, be with us. And so we hope people will do that and get your subscription triggering fingers ready for Blue Amp Media, which I am going to splash up on the screen here. And of course, my YouTube, worth knowing, on YouTube and on Substack. All right, that's it. Mark, I dragged you all the way here, and then I made you sit through an on-air ad. Wow.
Very cool. That's just quite a lineup. That's really cool. Yeah.
It is a 12-hour. Cliff did this last year, and I didn't even have a Substack yet. I popped on for 10 minutes while Cliff went to the bathroom to be a pinch hitting host, and I had 400 subscribers to a Substack that I didn't yet have. So it's a very, very cool thing, and I'm looking forward to it. Speaking of very, very cool, Mark, every conversation I have with you, I feel smarter. Here it is. Here's the link on Blue Amp, so you can catch it here live all freaking day tomorrow. Mark, every time we talk, I feel smarter. I feel better, not because of me, but because of you.
Well, thanks, Matt.
People who have been watching and listening feel the exact same way.
Very kind. I appreciate it. Always appreciate the opportunity. Always appreciate the conversation. So thank you very much.
What's the number one thing that you want to plug if people want to get more wisdom pearls of insight from you? Is it the pod?
Oh, I guess I'd plug if you're nerdy, you got to be a little nerdy listening to Matt. You might like my podcast on Inside Economics, because we really get down and dirty with the data. That question about the point about gig economy and UI claims, we talked about that on the pod, the Inside Economics.
Oh, I missed it. I missed the last one. Gosh, darn it. I am a subscriber. So
thank you.
I've actually been a previous guest, so I'm not
Yes,
just.
we got to get you back on. Yeah,
Oh,
because it's all election process. We got to get you back on. Yeah,
yeah,
sure.
you actually have election forecasting as part of the many things.
I've retired that model, man.
You retired it. Oh, geez.
We're gonna go AI now. We're gonna go AI model.
Maybe I'll help you revive. You never know.
Okay.
All right, man. Well, thanks so much. And to everyone out there, stay safe, be well. Hope to see you all tomorrow on the 12-hour live stream. Hang on till the very end. They saved the best for last in the cleanup position. So see you soon. Be well. Take care.